Please let me know if you can see my screen. Can you?
Yes.
Okay then. Thank
Yes,
you very
yes.
much. Yeah, good evening once again. My name is Adejuwan. I'm one of your tutors for financial management. Today is our first lecture day on financial management. And then without wasting more time, let's dive in straight into the lecture of the day. However, please, as a rule of engagement, I want to advise you that please, at all time, whenever we are having class, as soon as you join the class, ensure you mute yourself. If you want to if you want to ask any question or you need clarification, always raise your hand, and then certainly I will allow you to talk. So please avoid any background noise or anything that may disrupt the flow of the class. It's very important that you do this. All right. Okay. We are going to talk more, possibly not today or maybe after we could have covered a lot today. Then we can have a few minutes to introduce ourselves. But for now, let the class begin. All right. So for this diet, I have about 8 topics that I will be taking you. Our first topic will be cost of capital. Under cost of capital, I will introduce you to the topic, which is cost of capital. Then thereafter, we are going to talk about the importance of cost of capital. Then the next item we will discuss will be the categories of cost of capital, where we are going to be dissecting how to estimate traditional weighted average cost of capital, project-specific cost of capital, and the weighted average cost of capital of the combined activities. All right. This cost of capital will take us for the next minimum of 5 weekends, a maximum of 6, meaning that over a month, we are going to be dissecting the concept of cost of capital. It is very big because every other quantitative areas of financial management we involve the use of cost of capital. So cost of capital is linked to other topics in financial management, and that's why it will take that long. And also, it's a big scope. It's not something you can just do very on a lighter note and say, okay, I'm done with cost of capital. You have to be very deep. You have to go deeper because of the fact that when you get to capital budgeting, you will talk about cost of capital, particularly when we get to business valuation. And then, so if you don't have the foundational knowledge of cost of capital, you may struggle when you get to business valuation. And that's why I usually take my time to explain the details about cost of capital before we move into the next topic. So as soon as we are done with cost of capital, we are going to discuss capital investment decision, which is the same thing as capital budgeting. All right. So your scope under capital budgeting is limited to about about 4 techniques. All right. About 4 techniques. Under this, we are going to discuss um, we use some techniques that some techniques that can be used for the payback period, the internal rate of return. Every other techniques that can be used for project evaluation are not included in the scope of financial management. Techniques such as modified internal rate of return, project duration, adjusted present value, all those are not listed under your scope of financial management. But of course, when you get to strategic financial management at professional level, you'll be doing all of that. So as soon as we are done with capital budgeting, we are also going to dissect the risk and uncertainty. All right. We discuss risk and uncertainty. Then thereafter, we talk about specific investment decision. Under the specific investment decision, there are three things that are embedded, or let me call it two. There are two subtopics that are embedded in specific investment decision. One is asset replacement decision. This asset replacement decision will be taken by Mr. Ashiwaju. Okay, and the second one is lease versus hire purchase. Lease versus hire purchase, which is what I use this one for. Okay, this is lease versus hire purchase. So that's what we are going to discuss there. The other part of that specific investment decision will be taken by Mr. Ashwaju. Okay. All right. So that's that. Then thereafter, once we are done with specific investment decision, then we talk about portfolio theory. Okay. We talk about portfolio theory. After portfolio, we are going to do capital asset pricing model. Then we do working capital management. And lastly, we are going to dissect business valuation, a very interesting and bulky topic. All right, so these are the areas I'm going to be taking you for the diet. All right, so when you have Mr. Shiwaju on Wednesday, he will show you the other areas where he will be taking you. However, there are some specific scope of the syllabus of financial management, which you are going to read on your own, which are elementary. They are purely theoretical, like introduction to financial management. All right. What is financial management? What is financial objective? All right. Agency theory, okay, stakeholder theories, all those stuff, they are purely theoretical, so you can read them through. The regulatory background in relation to financial management, so you read about them too. Then financial environment, okay, you read about financial environment. You read about corporate governance. All of these are part of the scope of financial management. When you look at the course outline we shared with you, you will see self-study scope of the syllabus. So please do well to go through them. And I will advise you, if possible, you can even make it your first note, as in read through all of them and then just summarize your points. And then, so that going forward, it's your summarized notes that you are going to be referencing in relation to those areas that I mentioned. Now, this other one, which is mathematics of finance, initially when we developed this material, that was last diet. We envisaged that ICAN because mathematics of finance supposed to be part of the scope of the syllabus. But when ICAN released the syllabus, it wasn't there. And we also expected that when ICAN will release the study pack for financial management, they may likely include it, but uh, it wasn't there. All right. But for information purpose, there is nothing bad. You can just go there and read about mathematics of finance if you have the time. So that's basically that. Every other things you have on this that I did not mention, they are made for Mr. Ashiwaju, which he will talk about on Wednesday by the grace of God when he meets with you. Okay, then. So today we are going to be discussing cost of capital. That's our starting point. We are going to be discussing cost of capital. Okay. So what do you understand by cost of capital? What is cost of capital? So you can say uh, cost of capital is the compensation required by the providers of capital from their investments in a company. Okay, so I will repeat. Cost of capital represents the compensation required by the providers of capital from their investments in a company. All right. Who are the providers of capital? Providers of capital include ordinary shareholders, preference shareholders, and then the debt holders. These categories of investors they have contributed their funds to finance the operation of the company. Therefore, they are expecting that the company will pay a return. They are going to earn a return on their investments. All right. So the shareholders is expecting that the company will pay dividend as a form of return on the capital the owners have contributed into the business. The same thing applied to the preference shareholders. The preference shareholders is entitled to receive preference dividend from the company. Okay. Then, of course, please, you can open to the material. You have access to it if you do. For those of you in the FM group, so you have access, please open to the material. All right. Let me just increase the size a little bit so that to be bolder. Okay. All right. So the the debt holders, they've also contributed capital to finance the project or activity of the business. They are also entitled to return on their investment in form of interest. So the interest that the company will pay to the providers of capital, to the providers of debt capital, is a form of it's a kind of cost because the company will pay it out of its own profits, will pay the debt holder from his own profit. So it's a cash outflow. The same thing with the dividend. The dividend will be paid out of profit. So it's also like cash outflow. So you can see, and that's why this is what we call a compensation, because you are compensating the investors for contributing capital to finance the operation of the business. All right. Now, cost of capital generally is determined by the market forces of demand and supply. I repeat, cost of capital is determined by the market forces of demand and supply, and it will vary depending on the perceived risk associated with the company, which means that the higher the perceived risk associated with the company, the higher the cost of capital that the company will pay. If the investors think that the company is risky or they will be more exposed, they are going to be exposed to financial risk. So as a result of that, they may increase the interest that the company will pay. All right. So in doing that, the cost that the company will pay will also will go up. And that's why we are saying that the cost of capital depends on the perceived risk associated with the company. All right. So that is just the introduction to cost of capital. The next area we are going to discuss will then be the importance of cost of capital. You know, the importance or the significance of cost of capital cannot be overemphasized, particularly in achieving the optimal capital structure of a company. All right. However, there are two key importance of cost of capital, two key importance of cost of capital. When you talk about importance, what we are saying is that what are the usefulness, what are the significance of cost of capital? If examiner does not call it importance, examiner can say usefulness or significance. We are still saying the same thing. All right. And if don't write on my screen. Okay. So there are two key importance of cost of capital. One is project evaluation. One is project evaluation. In the determination of financial viability of a project. Please, guys, if I'm too fast, you have to call my attention. You know, we are not seeing physically, you know. I don't know, I can't read your mood. Please, if I'm too fast, let me know so that I can slow down. You need to understand the basics. I don't want you to cram, and that's why I will take my time to explain to you. Please, if I'm too fast, just call my attention. I will adjust because I wouldn't know. That's my nature. I talk fast. Yes, yes, you are too fast. Okay, Janet, I've heard you. I will adjust. Thank you. All right. So, like I said, one of the key importance of cost of capital is project evaluation. In the determination of financial viability of a project, cost of capital will be required to discount the expected future cash flows to its present value equivalent using relevant investment appraisal technique like net present value, internal rate of return, modified internal rate of return, or adjusted present value. All right. So when you want to appraise a project, you are going to need cost of capital to discount the future cash flows. So technically, it will be almost impossible to ascertain financial viability of a project without cost of capital. So you recall, for some of you that have done, maybe while you are undergraduates, you have calculated NPV before, or maybe you are coming from foundation, you have done NPV, you have calculated internal rate of return. In those techniques, examiner will just give you cost of capital to discount, but you wouldn't know how they arrive at the cost of capital. So how to estimate the cost of capital is what we are discussing. So what we are saying is that without the cost of capital, you will not be able to ascertain financial viability of a project. So that is one usefulness of cost of capital. The second one is to determining debt equity proportion. Okay, determining debt equity proportion. Now, in achieving optimal capital structure, cost of capital will be able to guide a firm to be able to determine the proportion of equity and debt to be considered in the company's capital structure. You want to know what is the percentage of equity, what is the mix of capital that you should carry in your statement of financial position or in your capital structure. Can we invest 60% of equity and 40% of debt, or can we do 50-50? All right. So this is what we mean by a mix of capital. All right. You want to know the percentage of equity and debt to be carried in the capital structure. So when I say capital structure, what I simply mean is that capital structure is the way and manner a company finances its operation. Ideally, there are three major sources of long-term financing, including ordinary share capital, preference share capital, as well as debt capital. Each sources of finance has its own underlying cost. So the objective of the company is to minimize the overall cost of capital to the firm. So by so doing, knowing how the percentage, knowing the proportion of equity and debt to be carried will enable the company to achieve its cost minimization objective. So this is the second reason, the second usefulness or significance of cost of capital. All right. I believe that is clear. Let me know, based on what we have discussed so far, let me know if you have any question. If not, then let's move on to discussing categories of cost of capital. Okay. All right. Now, majorly, at times, examiner can just ask you to calculate cost of capital or calculate weighted average cost of capital. There are different ways. There are three different ways in which you can calculate WACC, and that is what I call categories of cost of capital, right? So let me find a space. So like I said, there are three categories of cost of capital. Let me put it down for you. Categories of cost of capital. The first one is traditional weighted average cost of capital. The second one we are going to discuss will then be project specific project-specific cost of capital. Then number 3, the last category of cost of capital is weighted average cost of capital of the combined activities. Okay. So these are the 3 ways, or these are the 3 groups or categories of cost of capital. So when you see in a question under the requirements, an examiner is saying that calculate cost of capital, you need to ask yourself what kind of cost of capital. Is it traditional cost of capital? Is it project specific, or is it WACC? You must be able to know which one, based on the information given, you must be able to know which of the 3 WACC that you want to estimate. So we are going to take it one after the other. Now, don't remember what I said earlier. This topic, cost of capital, will take us for a minimum of 5 weekends or 5 weeks and maximum of 6 over a month for us to be able to dissect the topic. The traditional WACC will take up for like 3 to 4 periods. Then project specific, we can manage a period, or let's say 2 periods plus the WACC. WACC is the easiest, is easier than the other ones. Okay, so that is how we are going to carry out this. So we are starting with traditional WACC. We are starting with traditional WACC. Please, I will advise you, you can be jotting some notes so that particularly for all those key points, so that you don't mix out. Or maybe when you receive your video, you can be doing at your own convenience. You can be taking down your notes. All right. Okay, then. Now, we are going to be discussing today traditional WACC. When do you calculate traditional WACC? How do you estimate traditional WACC? That's what we are going to be discussing. All right. So, traditional WACC is computed when information about capital structure, including ordinary share capital, preference share capital, and debt capital, as well as their costs, such as the dividend and interest, are given. I repeat, Ayomide, don't write on my screen, please. I will repeat. When do you calculate traditional WACC? And I said, traditional WACC is computed when information about capital structure, including ordinary share capital, preference share capital, and debt capital, as well as their underlying costs, like dividend and interest, are given. So when you are given a question, and in the question you can see you are given statement of financial position, you are given balance sheets where you are given balance sheets where you can see ordinary share capital, preference share capital, and debt capital. And then in the additional information, you are given information about dividend and interest, or all those ones are also shown in your statement of profit or loss account. Then you are asked to calculate cost of capital. You need nobody to tell you that you are supposed to calculate traditional WACC, because each of these 3 categories of cost of capital has their own different ways or unique way of calculating the WACC. So what you are going to do under traditional WACC is what I'm telling you. Once in a question, you can see information about ordinary share capital, preference share capital, and debt capital. You can see information on dividend. You can see information on interest. Okay. So you need nobody to tell you that you are supposed to calculate traditional weighted average cost of capital. I believe that is clear. Now, how do you then estimate traditional WACC? There are four different procedures that you are going to carry out anytime you want to compute traditional WACC. Okay, let me do it this way. Let me do it this way. Okay. Let me stop sharing this so that I can flow properly. Let me stop sharing. I will need, if I want to do examples. Okay, let's just manage. Let me see if I can get some space. Okay. Uh, let's write them. Now, let me try and write it down somewhere for you, just in case. So I said that traditional WACC, traditional WACC is computed when information about capital structure such as ordinary share capital, preference share capital, and debt capital, including dividend and interest, are provided. Okay, are given. So that is when you compute. That is when you are expected to calculate traditional WACC. So what are the procedures for calculating traditional WACC? Okay, let me put it down for you. Steps involved in the calculation of traditional WACC. Step 1, you estimate or you calculate cost of equity. Calculate cost of equity. Step 2, compute cost of preference shares. Then step 3, determine cost of debts. Then finally, step 4, estimate weighted average cost of capital. So these are the 4 procedures you are supposed to carry out anytime you want to estimate weighted average cost of capital. No matter how big is the question, you can't go beyond these four steps. However, at times, if in the capital structure you don't have preference share, that means you are only going to carry out three procedures, three steps. So you are going to ignore step two. So depending on the nature of the question, oftentimes preference share is considered to be a kind of hybrid source of finance because it has the element of equity and debt. So it combines both elements of equity and debt. So oftentimes, as examiner may not give it to you in a question, but if you have it in a question, you must carry out these four procedures. But if you don't have preference share, certainly you are going to have equity. Then also you may likely have, in most cases, you are going to have debt as a form of finance in the question. All right. So let's take it one after the other. Today we are going to be dissecting cost of equity. So once we are done with cost of equity, we move to estimating cost of preference share, then cost of debt. Then after cost of debt, we are going to talk about cost of convertible securities. Once we are done with cost of convertible, then we move to weighted average cost of capital. Now, all these four procedures that I just mentioned to you may look very simple, but there are concepts, there are principles that we are going to be testing, you are going to learn new principles in relation to these areas that I've listed. So let's take it one after the other. So we are going to start with estimating cost of equity. So I can then go back to the material. Let's talk about cost of equity. Now, what do you mean by cost of equity? Let me know if you guys are still with me. Please, one of you should tell me, hi, I'm here. Yes,
We
I
are
want
with
to.
you, sir. I'm here,
Okay,
sir.
thank you. I just want to be sure that I'm not speaking into the basket. All right. Okay. Yeah, thank you. I think that's Edward. Okay. All right then. So let's talk about cost of equity. What do you mean by cost of equity? You know, earlier today, I mentioned to you that there are three providers of capital to the companies. We have ordinary shareholders, preference shareholders, and then the debt holders. Those are the providers or suppliers of funds. Okay. Now, when you talk about cost of equity, I mentioned the other time that the shareholders that have contributed capital to finance the operation of the company, to set up the company, they are expecting that because they set up the company not because they do it for charity. Because any company, when you say company, the primary purpose of every business organization or of every company is to maximize owners' equity value. All right. The primary purpose is that you want to make profits. As a limited liability company, the essence why you are in business is to make profit, not for charity. Okay. So the owners of the business, they have contributed their capital to set up the business, to finance the operation of the business, with the expectation that if tomorrow or in the future the company does well, I'll be able to earn return on my investments. The return on investment that the shareholders will earn from the business is dividend income. All right. Therefore, that dividend income, it is the company that is paying it to the shareholders. So because the money, the dividend will be paid out of profit. Therefore, cash is going out, money is going out. So that is a cost to the company. So when you now talk about cost of equity, we can say cost of equity is the minimum required rate of return expected by ordinary shareholders from their investments in the firm. Okay? is the minimum required rate of return expected by the ordinary shareholders from their investment in the firm. All right. So we can also say that cost of capital is the opportunity, it's also known as opportunity cost of capital. Why is it so? Why is it regarded as opportunity cost of capital? Because the owners of the business that contributed capital to finance to set up the company, they could have take the money somewhere else. Instead of investing it in the company, instead of setting up the company, they could have invested in another company or another business venture. But because they decided the benefit that could have accrued to the owners from other business venture, they are going to forgo it. So that's a lost benefit. That is opportunity cost. All right, that's opportunity cost. Okay, so that's basically what cost of equity is all about. The minimum required rate of return expected by the ordinary shareholders from their investments in a company or a firm. All right. Now, how do you then estimate cost of equity? Let's talk about estimating cost of equity. Majorly, there are three different ways in which you can calculate cost of equity. There are three methods of calculating cost of equity. One is dividend valuation model. We can use dividend valuation model to calculate cost of equity. We can use capital asset pricing model to calculate cost of equity. Then we can also use Miller and Modigliani to calculate cost of equity. Now, we are starting with dividend valuation model. Capital asset pricing model is a topic on its own. You recall earlier when I was showing you the cost outline. So capital asset pricing model is a topic which we are going to discuss extensively when we get there. All right. But for now, our focus is on dividend valuation model. So let's talk about dividend valuation model. When do you use dividend valuation model to calculate cost of equity? Dividend valuation model is used for calculating cost of equity when information about dividend and share price are given. I repeat, dividend valuation model is used for calculating cost of equity when information about dividend and share price are given. So if in a question you want to calculate cost of equity, you can see information about dividend, you can see information about share price, then you need nobody to tell you that you are supposed to calculate cost of equity using dividend valuation model. So for this purpose, using dividend valuation model, cost of equity represents the ratio of dividend to ex-div share price. Or let me just say share price. Let's forget about ex-div for now. So I repeat, using dividend valuation model, cost of equity is the ratio of dividend to share price. Now, the cost of equity can be calculated as follows using the formula below, depending on whether dividend will grow or dividend will remain constant to perpetuity. All right. Remember, I said cost of equity is the ratio of dividend to share price. Now, where dividend will remain constant to perpetuity, then cost of equity will be calculated as dividend divided by ex-div share price. So at this point, I'd like to use, let me rewrite the formula for you. Let me rewrite the formula for cost of equity. Okay. Constant, let me put it this way, for constant dividend, where you are given constant dividend, there is no growth. So in this case, so I said cost of equity is equal to the current dividend current dividend is denoted as DO. So over XDIV, X dividend, share price, multiply by 100 over 1. So I like to use XDIV for my XDIV share price for my denominator so that you don't forget. Because if I use later, there's likelihood for a student to forget that. But when you write XDIV share price, something will call your attention to go and check if dividend has been paid. All right. So later on, we are going to be discussing CumDiv, the concept of CumDiv and XDiv share price. What do they mean? All right. Which one is appropriate for the calculation of cost of equity? We will discuss it later. All right. So when you want to calculate cost of equity, where dividend will remain constant to perpetuity, is simply the current dividend over XDiv share price multiplied by 100%. Because you are calculating cost of capital, it has to be in percentage, and that's why you are multiplying it with 100%. I believe that is clear. Now, the second one is where there is growth. Where there is growth in dividend payment. Let me put it down for you. Where there is growth in dividend payment. So in this case, where there's growth in dividend payments, you have to introduce your formula will change a little bit. Therefore, cost of equity will be equal to the current dividend. Remember, here I mentioned to you that current dividend is denoted as DO. Okay? So, current dividend multiplied by 1 plus the growth rate. All of this divided by XDIV. X dividend share price. Okay, then plus the growth rates, all multiplied by 100 over 1. Please, you have to be very careful. Oftentimes, students make mistake. So, it is current dividend multiplied by 1 plus the growth rates divided by XDiv share price. Whatever you have, then you now add the growth rates plus the growth, then multiply by 100%. At times, students will just multiply, say the numerator, D whole multiplied by 1 plus G, then divided by XDiv share price. When you do that, you can't get the right answer. So it has to be the D whole plus 1 plus D whole multiplied by 1 plus G divided by XDiv share price equal, then plus G equal, multiplied by 100%. You get the final answer. That's the right thing to do. Okay, and I believe that is clear. So these are the two formulas that you are going to use to calculate cost of equity. I said that there are two different ways we can calculate cost of equity using dividend valuation model, depending on whether dividend will remain constant or dividend will grow to perpetuity. Where dividend will remain constant, cost of equity is simply current dividend divided by XDIV share price. But uh, where dividend will grow to perpetuity, then cost of equity will be computed as current dividend multiplied by 1 plus the growth rate divided by XDiv share price plus the growth rates, then multiplied by 100%. So we don't need the market value for now. We only use that market value when we want to calculate business under business valuation. When we get there, we'll be discussing about that. Yes, okay. That is for that. What else? Now, you can see from our formula that's okay. I will explain, I will define G as we move on. All right. I will define it later on. But for now, let's keep it as it is. Let's keep it simple. Now, you can see from this, our formulas, we have XD share price. Okay. So let's talk about the concept of CumDiv share price and XDiv share price. What do they mean? Which one is more appropriate to use? All right, let's discuss it. Let me look for a space. All right, I can manage here. So let's talk about concept of cum div and ex div. Concept of cum div and ex div share price. Okay. Since it's not in your notes, let me write it down for you. Now, when you talk about ordinarily, when you want to calculate cost of equity, you are going to need share using dividend valuation model. You are going to need share price, and the share price you are going to use must be the share price after you have paid the dividend. But in most cases in your exam, you may likely not be given the share price that exclude dividend. Examiner will always may want to give to you. Examiner may want to give you the share price that includes dividend. Therefore, you must know what is cum div share price, what is ex div share price. All these concepts, you have to know it. It's part of the learning you must know. Okay, then. So what do you mean by cum div share price? The cum div share price, cum div share price, let me write it in full. The cum div share price is the share price that includes dividends. On the flip side, ex div share price represents the share price that excludes dividend. Okay. So in the calculation of cost of equity, in the calculation of cost of equity, only the ex div share price only the ex div share price is used. Therefore, when cum div, let me push this to the front a little bit. When cum div share price is given, it should be converted See, now I'm writing your note for you. If you are to be in the physical class, all this I'll just be dictating it for you. So I have to treat you like my baby, you know? You deserve it. All right. It should be converted to xdiv before calculating cost of equity. Okay, as follows. All right. So anytime you want to calculate cost of equity and you are given cum div share price, you have to convert it to ex div share price. How do you do that? You can use it as a formula or as a table. However you want to do it, you still get the same thing. So let's use formula. You can say ex div share price equal to cum div share price minus current dividend. Okay, so that's the formula for calculating ex div share price. If you want to use a table, all right, just draw your table, put your Naira sign. So for your ex div, let me shift a little bit. So if you want to calculate your ex div, ex dividend share price is cum div share price that is given to you, then you less the current dividend. So whatever you have thereafter is your ex div. Okay. Now, in a question, once there's an indication that dividend has not been paid, examiner can tell you that, okay, company XYZ PLC has ordinary share capital of 1 million naira, currently quoted at 1 naira 25 kobo, cum div, 1 naira 50 kobo or 2 naira, cum div. So you have been given a share price of 2 naira, and examiner mentioned cum div. So once you can see cum div in the question, it means that dividend has not been paid. So what you are supposed to do is to go ahead, calculate dividend per share if it's not given to you. So deduct.
How your family? Longest time. We thank God, sir.
Ahmed, well done. Ahmed, well done. Longest time. Okay, then let's move on. Yeah. So once you are told in the question, you can see indication in the question, or maybe examiner give it to you directly. You are given a share price, cum div. So once you can see cum div, it means that dividend has not been paid. So you cannot use that share price that include dividend. It has to be the share price that exclude dividend. That is ex div share price. So all you need to do is to just come here, go and do your workings. Either you use this format or you use the tabular format, you get the same thing. Whichever one that is more convenient for you. So you calculate your ex-div share price, then you now go back to calculate your cost of equity. This is what I'm trying to say. Now, after you have computed your ex-div share price using this format or formula, then you now go back to your cost of equity. The cost of equity I've given you here. So this place where you have ex-div share price, if it is the one with growth, this place, so whatever the working you have done is what we are going to put there. So now, like I mentioned to you, there are different ways the examiner can indicate it in the question that dividend has not been paid. The easiest one is that the share price given to you in the question, examiner will call it cum div. That, okay, company XYZ with ordinary share capital of 10 million naira, currently quoted at 1 naira 50 kobo, cum div. So once you can see that cum div, it means that dividend has not been paid. Another way is that examiner will not tell you that it is cum div, but there will be indication that dividend has not been paid. Examiner can tell you that the dividend, the current year dividend is about to be paid or the dividend is yet to be paid, or dividend will be paid. All right. Once there's an indication in the question that dividend has not been paid, it means that the share price given to you is cum div. And I told you, we don't use cum div to calculate cost of equity. It has to be ex-div share price. It has to be ex-div share price. So that is the concept of cum div and ex-div share price. And I believe that is clear. Now, the final areas we are going to touch in relation to cost of equity will then be the calculation, how to estimate growth rates. Let's talk about how to estimate growth rates. You remember in this formula of calculating cost of equity, you have G. This G that you have in the formula, how do you estimate it? All right, so let's talk about it. Now, estimating growth rate. Ordinarily, the investors or ordinary shareholders will expect that the dividend earned in a company will grow over time or will increase over time. No investor, no shareholder will want to earn the same dividend income every year due to some economic condition or market condition. All right, every investor will want an increase in dividend they earn or they receive from a firm. All right, because the value of the dividend they earn, for example, in 2025 will not be the same thing as the value of dividend they are going to earn in 2026 because of price level changes. Inflation can erode the value of money. So as a result, what you can buy with the dividend you earned last year is not the same thing again. So if company is paying you the same amount of dividend every year, so that means the dividend you earn will be reducing in value. And that's why an ordinary investor or shareholder will expect that the dividend will grow on a consistent basis. All right. And that's why you see some companies that do pay dividend, they try as much as possible to factor in this kind of increment every time they are paying dividend. Okay. So now, how do you then estimate growth rates? There are two methods of calculating growth rates. Number one, the first method is to use historical pattern of dividend payments. Then the second method is to use Gordon growth model. You can use Gordon growth model. Those are the two methods that you can use to estimate growth rates. Now, let's pick the first one, which is the historical pattern of dividend payments. The historical patterns of dividend payment is also known as averaging method. Okay, this is also known as averaging method. Okay, this method assumes that the past pattern of dividend is a fair indicator of the future. So when do you use historical pattern of dividend payment? When do you use averaging method to calculate growth rates? The historical pattern of dividend payment is used when the past information about dividend payment are given. When the history of dividend payments are given in a question, that means you are supposed to use historical pattern of dividend payments. However, there are two different formulas that you can use to calculate the growth rates under the historical pattern. There are two different formulas. Let me demonstrate that for you. Then I will also explain how and when you should use each of them. Now, when you want to calculate the growth rates using averaging method, the first one, okay, the first formula is where you are going to use this formula where the information, let me put it down. This is used. Okay, let me just write out the formula first before I'll tell you that. All right. So to calculate the growth rates, this is n minus 1 into square root latest dividend divided by dividend paid in the first year, or minus 1. So when do you use this formula? Let me rewrite this L. Okay. When do you use this formula? This is used. It's not in your notes. Let me put it down for you for clarity. This is used when information about dividend payments are given for all the relevant years. Okay, so when you are given the history of dividend payment for all relevant years, then that means you are supposed to use this formula to calculate your growth rate. So for example, let me see. Okay, let me manage here. For example, let me do it this way. For example, so in a question, our examiner can give you something like this. You can create a column for year, then dividend paid for each year. Let's say you have year 1, year 2, year 3, then year 4. So in year 1, let's say you are given a dividend of 10 naira. Year 2, dividend of 12 naira. That space is not sufficient. And I want to use this one for the other one. Let me see. Okay. Let me come down. So you need to understand this. The beauty, I like what ICAN has done by introducing financial management to skills level. So the objective will be to expose you to fundamentals of financial management, so that when you get to professional level doing strategic financial management, you already have idea. No student that passed through skills level should fail strategic financial management, because most of the things you are going to do in SFM would have done it, you would have had the idea under the financial management. Even the only difference may just be that, okay, the technicality, your professional judgments, the quality of the questions that you are going to get under strategic financial management, maybe, of course, will certainly be different from what you are going to get under the financial management. But give and take is the same. The cost of capital we are doing now, when you get to professional level, we are still going to do it, right? So it's a plus for you and then for ICAN. Now, I was trying to give you example. The way examiner will set the question using the first formula. All right. So you create a column. Examiner will give you a year, then dividend paid for each year. Let's say this is 2021. This is 2022. This is 2023. Then 2024. All right. So let's say the amount of dividend paid in 2021, 10 naira, 12 naira, 15 naira, then 18 naira. You can see from these hypothetical figures, from these our examples, that dividend are paid for all the relevant years. For the 4 years, you are given the amount of the dividend paid. So when you are given this kind of information, it means that this is the formula you are supposed to use. You use this formula when information about dividend payment for all the relevant years are given. Okay, so you can see in this case. So if I want to use this example now to calculate my growth rate, all I will say is just that G is equal to my N from the formula. N is number of years dividend is paid. Okay, N equal to number of years dividend is paid. ID is the latest or current dividend. BD is the dividend paid in the first year. Let me see, I can put it here. N is equal to number of years. Dividend is paid. Then LD equal to current slash latest dividend. Let me give a space. Then BD equal to dividend paid in the first year. Okay, so that's that. Now, using this hypothetical figure, if I now want to calculate, because dividends are given for all the relevant years, so from the formula, N will be equal to 4, because from 2021 to 2024, that's 4 years. That means our N is equal to 4, then minus 1 into the square root. ID is current year dividend. The current year is 2024, and dividend in 2024 is 18 over BD. BD is the first year dividend, all right? Dividend paid in the first year, which is, from our example, is 10. Here will be equal to 10, all minus 1. So in this case, G will be equal to 3 into square root. 18 divided by 10 will give us 1.8, all minus 1. So you just put your calculator, you get the final answer. If you don't know how to use second function on your calculator, so mathematically you can bring this one down to say G is equal to 1.8 raised to power. What you have outside the square root, you take it as a power of what you have inside. So raised to power 1 over 3, or minus 1. Whatever the answer you get, that will be the growth rate. All right, that will be the growth rate. So in this case now, if I want to get the final answer from my calculator, I can say 1 divided by 3 is 0.333, whatever. So I will just say 1.8 raised to power 0.3333. All right. So we got around 21.6, 1.2164, whatever. Then minus 1. So that will give us 0.2164, then multiply by 100%. So that gives us a 21.6%. So our G is equal to approximately is 22%. All right, it's approximately 22%. You can see, so dividend has grown, has increased from 10 naira to 18 naira within the 4 years, within the 4 years period, increment of 22%. All right, increment of 22%. Somebody is sending a chat. Let me check. What's BD? Yes, I said BD is dividend paid in the first year. Yes, somebody has also answered you. Base year dividend. You can call it base year dividend or dividend paid in the first year. Thank you guys for responding on my behalf. All right then. So that is how to calculate growth rates using the historical pattern of dividend payment. The second formula The second formula is, let me say, what did I put in the first one? Okay, I just wrote out the formula. Let me circle it for you so that you know. Okay. Then the second formula is G equal to N into square root latest dividend over dividend paid in the first year, all minus 1. Okay, let me push this one down. Okay, so you can see there's difference between the first one and the second one. This second one does not have minus 1. So when do you use this second formula? This is used, let me put it down for you. This is used when information about the current year, let me write this one properly. When information about the first year dividend dividend and the current year dividend are given. So that is when you use this particular formula. You use this when information about the current year and then the first year dividend are given. So let's say, for example, let me see. I need a space that is closer to this. Okay, you can get it since let me just put it there. For that example, let me use here. Let me save this one. So examiner can tell you that, for example, the examiner can tell you that the dividend paid 5 years ago is 4 naira. Why the current year dividend is 15 naira. You can see examiner did not list the history of dividend paid year on year or for all the relevant year. We're only given the dividend paid for the first year and the current year. So when that happens, we are supposed to use this second formula to calculate the growth rate. So in this case now, if I want to calculate my my growth rate using this example, let me remove this. I will just say G is equal to N will be equal to 5 because you are told that the dividend paid 5 years ago is 4 naira. So N is equal to 5. So here will be equal to 5 into square root. LD is the latest dividend. So the current year dividend is 15 naira. So here will be equal to 15, right? Then BD is the dividend paid in the first year. So dividend paid 5 years ago is 4 naira. So divided by 4, all minus 1. So mathematically, I will get my answer. This will be equal to G into 5 equal to 5 divided by 15 divided by 4. Okay, from your calculator, 15 divided by 4 will give us 3.75. So here will be 3.75 minus 1. So put it in your calculator, you get the final answer. All right, so that is when you are going to use the second one for calculating the growth rates. Okay, so before we move to Gordon growth, please let me know if you have any question for me so that I'm not talking alone. Okay, if you have any question for me, let me know. If not, I will move on to discussing Gordon growth model.
Good evening, sir.
Yes, who is speaking?
This is Emeka.
Okay, talk to me, Emeka.
Yes, sir. I just want to know how you got that 22%. I'm trying to use my calculator to calculate that last part before you got that 22%.
So what did you get in your calculator?
It's not even showing me, it's giving me 40 something percent. Maybe I didn't know how to go about it. That
So
one
from your
bracket,
calculator, this is what you are going to hold on. This is what you are going to do. From here, so from your calculator, you are going to press 1 over 3. 1 over 3 will give you 0.33333, whatever. Are you there,
okay.
Emeka?
Yes, sir.
So if you are using Casio calculator, if you are using Casio, you keep it after you have pressed answer, just leave it there. Then from your calculator, just press 1.8.
Okay.
So 1.8 raised to power answer.
Come again, sir. Come again, sir.
Okay. From your calculator, you press 1 over 3 equal
Okay.
to, what did you get?
0.3333.
So leave it as it is. So just press 1.8.
Okay.
Have you done that?
Yes,
Then
sir.
raised to power answer
Okay.
equal to, what did you get?
Oh, sir, just go on. I will still try it later. Just continue with the lecture. Let me not waste your time.
No worries. Some people, I'm very sure some some other students are in similar shoe as you have. So just go ahead. I want to be sure that you get it.
You said 1 over, I should divide 1 over 3.
1 over 3, then you press equal to,
Okay.
then leave it as it is. Just press 1.8 from your calculator.
Okay.
Raised to power answer.
Raised to
There is
power
a button
answer.
for answer in your calculator.
Raised to power answer.
Then equal to. Have you done that?
I'm using my phone. That's why I think
Oh,
maybe I'm having the.
why could you be using for? No worries, no wonder you are struggling. Okay, then. Okay, when you have your calculator, you can try it. By the time you
Okay,
listen
sir.
to the video, you will get it. All right?
Thank you, sir.
Yes, you're welcome. Kemi, you raise and talk to me.
Good evening, sir.
Good evening.
Now, the cost of capital is determined by the market forces of demand and supply. Please, can you
Yes.
please cheat on that? I'm so sorry.
Yes, what we are saying is that when you say cost of capital is determined by the market forces of demand and supply, the interaction of the buyer and seller. See, I have money to lend out. All right. So that means I am the seller. I have money to give out to for borrow whoever that needs money. So I'm the seller. For example, you need money for a project for a particular purpose. All right, you are the buyer. You will come to me for money. So at the end of the day, when we interact, we agree. All right, I will agree to give you the money. Then you also agree to pay me the return on my investment. So it is the more people that are seeking to for my funds, the more That means if I have more people that are seeking for my funds, that means there are more demand relative to the funds available. So because I have seen many people that are seeking for funds from my company or from my firm, then I may likely increase because there are more people that want to get the funds. I will increase the rates. Do you get now? So that's why we say it is determined by the market forces of demand and supply. When the buyers and the seller, the person that has money, the company that needs money, that needs loan, and the company that has sufficient loan, I mean, that has loans to give out. So when they interact and depending, so if there are more people that are willing to lend money to me as if I'm seeking for loan, and there are so many companies that are out there that wants to give me loan. So that means I have surplus, there are surplus funds in the market, and there are few people looking for loans. All right. So in that case, the interest that the company will pay will also be low. All right. So depending on the market forces of demand and supply, that is what will determine how much capital, the cost you are going to pay on the capital that you want to get. Is it clear now, Kemi?
Yes, sir. Thank you, sir.
You're welcome. Okay, so the
Hello,
last
sir.
area,
Sir, please, I have a question.
who is speaking? You did not raise your hand. Yeah, talk to me.
Sorry, sir. Okay, I was trying to use my calculator to get that percentage, but I don't know how to go about it. So I don't know if you can.
Which one? You made it 22%.
Yes, sir.
So, okay, this is what I said. From your calculator now, you are going to start from the power. All right, you start from the power. So 1/3, press 1/3 from your calculator. Are you there?
Yes, sir.
What did you get? What did you get? 1
Okay,
divided by 3, what did you get?
1 divided by 3.
I said you should press 1/3, 1 divided by 3.
Still showing me 1 divided by 3. I don't know. Maybe it's my
Is
calculator.
your calculator? Okay, I think you have not set your calculator. That's why it's showing you 1/3, and that's why you are not getting the right answer. I think from the screen of that your calculator is showing mathematics or mathematical something, right?
Yes.
So you have not set your calculator. You need to set it. That's why it's showing you. That's why you are not getting it. So you
Okay,
need to
sir.
set it. You need to reset your calculator.
Okay,
All
sir.
right. So what you
Yes,
are
sir.
going to do is that you are going to start from the power. Here is 1/3. So from your calculator, you press 1/3. That will give you 0.333, whatever. Then after you have pressed answer, just leave the answer. Then you press 1.8 in your calculator. So 1.8 raised to power the answer you have gotten before. Then you press equal to. After equal to, you press -1. Then after -1, you multiply with 100%. So it will give you 21.6. So when you round it, it will be 22%. So yeah.
Thank you, sir.
Okay then. Yeah, welcome. Now, so the last area under cost of equity, the last concept we are going to discuss will then be the Gordon growth, model. We have talked about historical pattern of dividend payment. The next one will then be the Gordon growth. All right. Now, the Gordon growth model is used for calculating the growth rates when information about earnings and capital employed are given. Okay, let me put it down for you. Let me see if I have space down here. Okay, Gordon growth. Gordon growth model. So I said this is used for calculating growth rates. When information about earnings, you can call it earnings or profit after tax, is the same. And capital employed are given. Okay, so that is when you use Gordon growth to calculate growth rates. All right. Certainly, examiner will give you the information. If examiner wants you to use Gordon growth, you are going to see this information there. If not, examiner will just give to you information about the history of dividend, the past information about dividend payments. All right. Okay, then. So using Gordon growth rate is calculated as return on capital employed multiplied by the retention rate. Let me define it for you. Where R equal to return on capital employed. Let me manage here. B equal to retention rates. Okay, let me give a space. All right. So where B is equal to retention rates. All right. So that is that. Now, when you want to calculate the growth rate using Gordon growth model, you need to first of all calculate return on investments as well as the retention rates before you can then come back to come and use this formula before you can calculate this. All right. You need to first of all go and calculate return on investment as well as the retention rate. So how do you then calculate the return on capital employed as well as the retention rates? Let me show you, or let me just go back up there. Let me see. Should I? Where is it? Okay. Is this one sufficient? Okay, let me add more. Let me look for space. Okay. So the return on capital employed is calculated as earnings, depending on the information available. So it's calculated as earnings, or what we call profit after tax, over capital employed. Okay, over capital employed, all multiplied by 100%. Please note, your growth rate must be in percentage, all right? It has to be in percentage. Or you can also say return on investment or return on capital employed is earnings over opening shareholders' funds. In case if you are not given capital employed, then you can use opening shareholders' funds. I will define the variables later on, then multiply by 100%. So that's that. Then the second one, which is the retention. B is retention rate, and retention rate is calculated as earnings minus profit after tax, sorry, minus the dividend, minus total dividend. Let me shift to the right. Minus total dividend divided by earnings. multiply by 100%. So that will give you the retention. What we are saying is that out of the profit after tax achieved by the company in a year, part of the profit after tax attributable to the owners, part of it will be paid as dividend to the shareholders. So the balance will be retained in the business for growth and expansion. So the percentage retained in the business is the retention rate. Okay? So if it is not calculated as this, then you can also say retention rate equal to earnings per share minus dividend per share divided by earnings per share multiplied by 100 over 1. Or you can say earnings if in the question you are given dividend payout ratio. The dividend payout ratio is the proportion of earnings that is paid as dividend to the shareholders. Therefore, if the dividend payout ratio is given to you and you want to calculate the retention rate, then, so like I said, if dividend payout ratio, of course, to be given to you in a percentage. So in this case, it will be 1 minus dividend payout ratio. Okay, so the balance you have thereafter will then be the retention rates. Okay, so let me just define some variables for you. Where, let's start with PAT. You guys should know PAT, profit after tax. Let me just put it down. PAT, profit after tax. Then SHF, shareholders fund. Then we have DPR, EPS, earnings per share. Then we have DPS, dividend per share. Then we have DPR, which is dividend payouts ratio. Okay, so that's that. So I believe when you are forming your notes, you'll be able to follow through. All right. Okay, then. Now, so far, so good. We have discussed introduction to cost of capital. After that, we talked about the importance of cost of capital. Then the next item we discussed was categories of cost of capital, where we dissected cost of equity. We mentioned that there are 4 procedures for calculating traditional WACC. All right. We talk about cost of equity, calculating cost of equity, cost of preference share, cost of debt, then cost of, weighted average cost of capital. We now we brought out the cost of equity. All right. So we talk about cost of equity, how to estimate cost of equity. We now said, okay, there are some concepts, there are some principles you must understand in relation to cost of equity. One of them is cum div and ex div share price. We talk about cum div. What do you mean by cum div? What do you mean by ex div? Which of the two do you use for calculating cost of equity? Then thereafter, we also talk about how to calculate growth rates. Then we said there are 2 methods of calculating growth rates. We can either use historical pattern of dividend payment or Gordon growth model. And then we explain the 2 of them and when and how. We explain when and how you should use each methods of calculating a growth rate. So far, so good. That is what we have discussed. So before we proceed, the next thing we are going to do now is to have short examples to demonstrate, uh, our learnings so that we'll be able to take something home. All right. These short examples is just to practice the principle, not the real exam question that you are going to see on the day of your exam. Just for us, this short example is just to test all those things, all the principle underlying cost of equity. But before we do that, let me know if you have any question for me. Let me know if you have any question for me before I move to the next one. After the examples, then we call it a day. Okay? So if there's no question, then let me scroll down if I can see few the kind of examples I'm looking for if I have it there. If not, I can just open the golden book. Okay, I have some of them. Okay, let's try this one first. Yes, let me see who are the people online. Olalekan, Adewale Kehinde Raphael, Akinola Kayode, Alabi Kayode. Now, I need one of you to read for us. If not, I will call. Okay, let me even hear from Daisy. I've been chatting with Daisy, even Chidera too. Daisy, are you on? Or you are attending by proxy? Daisy,
I'm here, sir.
okay. Please read illustration number 1. This is the example. Read it for us. Arsenal PLC.
Arsenal PLC is financed with 10 million ordinary shares of 1 naira each, currently quoted at 1 naira 25 kobo cum div. The company current dividend of 22 kobo is about to be paid, and the dividends will remain constant to
Perpetuity.
perpetuity. You are
Read on.
required to calculate company cost of equity.
Okay, thank you. Yes. You can see from the question, pay attention, please. Anytime you are given a question, it's advisable to always start from the requirements because the requirement will prepare your mind on the expectation of the examiner. So when you go to the requirement, like in this case, you are to calculate cost of equity. So you need to ask yourself, what kind of cost of equity do you want to calculate? Is it cost of equity using dividend valuation model? Is it cost of equity using the capital asset pricing model or Miller and Modigliani formula? So you must know which one you want to calculate depending on the information available. You will recall earlier today, I mentioned to you that when information that you use dividend valuation model to calculate cost of equity, when information about dividend and share price are given in a question. So in this question, examiner has given you share price. When you are told that currently quoted price means share price. Okay, quoted price means share price. And you are given information about share price as well as a dividend of 22 kobo. So it means that you are supposed to use dividend valuation model to calculate cost of equity. I hope you are flowing with it. Now, using dividend valuation model, I gave you two different formulas. One where there is no growth and the other one where there is growth. So according to this question, examiner told us that the dividend will remain constant to perpetuity. That means there is no growth. So if there is no growth, so to solve this question, I will just say I will write the name of the company so that examiner will know the question I'm treating. So I will say Arsenal PLC. That's the name of the company. So what am I asked to do? I have to indicate what I want to do. So I can just say calculating cost of equity. Denoted as KE. Okay, I will underline it. Therefore, cost of equity, because we said where there is no growth, so cost of equity will be the current dividend, which is DO, current dividend, divided by XDIV, share price, ex-dividend share price, multiplied by 100 over 1. So that's the formula we are going to use. So equal to, I will then move to the next line. Let me shift a little bit. So then say KE equal to, let me remove this. So KE, I will then go back to the question, what is my, DO is current dividend. My current dividend, according to the question, is 22 kobo. So here will be 0.22 over XDIV share price. I will then go back to the question. I will need to go and identify share price. You are told that the company's share is currently quoted at 1 naira 25 kobo, cum div. So with the name as implied, cum div, it means that this dividend of 22 kobo has not been paid. That is why examiner is giving me cum div. But to make life easy for you, examiner also mentioned that the dividend of 22 kobo is about to be paid. That's tautology. You are repeating things twice. Because I've already seen it from this information that this 1 naira 25 kobo is cum div. Now here again, you are telling me it's about to be paid. All right, but that notwithstanding. So now that we have seen in the question that dividend has not been paid, therefore, we cannot use that 1 naira 25 kobo because the 1 naira 25 kobo includes dividend. We need the share price that excludes dividend. Therefore, we need to go and calculate XDIV share price. So I will then call me XDIV share price. Let me see if I can manage here. So I will then say XDIV. I will go and do my working for XDIV share price. So to get the XDIV share price, I will pick from the question, I'm going to pick the cum div share price. The cum div share price is 1 naira 25 kobo. The current, I will less current dividend. Current dividend is 22 kobo. So the difference of 1 naira 3 kobo represents the XDIV share price. Okay, so I will then come here 1.03. That's the XDIV share price. Then because I'm calculating cost of equity, I need to multiply with 100%. So from your calculator, what do you have? Dicey, do you have calculator with you?
Yes, I do.
So what do you have? 0.22 divided by 1.03, all multiplied by 100%. What does it give you?
21.35.
21.35%. So approximately 21%.
Point.
So cost of equity of Arsenal PLC is approximately 21%. Please, guys, if you don't understand what we have done so far under this question, please raise your hand. I will explain to you. All right? Because this foundation, foundation is very important. If you get this correctly, if you understand cost of capital very well, you won't have issue when you get to business valuation. Okay? So, in the absence of no further question under this, let's move to the second one. in the second example of Sanchez PLC, I need another person apart from Daisy to read for us. Yes, I need okay. I need hardware to read. I don't need I need hardware to read for me. Or Nigerian content like NTA, Channels TV. I mean a guy. Kayode, are you there? Kayode, you want to read?
Yes, sir.
Okay, go ahead.
Sanchez PLC is financed with 20 million ordinary share capital of ₦1 each, currently quoted at 1.25 kobo. The company's current dividend of 20,000 is about to be paid,
20 kobo.
and this kobo is about to be paid. Dividend will grow at a rate of 5% per annum to perpetuity. Required. What is the company's cost of equity?
Okay, thank you. So you can see this second question is slightly different from the first one that we solved. In this second one, we are given a growth rate of 5% per annum to perpetuity. So where there is growth, you cannot use the same formula again. So that means you have to introduce growth. So in this case, let's see how we are going to solve the question. According to the question, we are told that Sanchez PLC is financed with 20 million ordinary share capital of ₦1 each, currently quoted at ₦1.25 kobo. The company's current dividend of 20 kobo is about to be paid, and this dividend will grow at a rate of 5% per annum to perpetuity. So you have to calculate cost of equity. So I will then come here to solve this question. I will say Sanchez, first thing first, Sanchez PLC. I will indicate the name of the company, then what I want to calculate. I can then say calculating cost of equity. We want to calculate cost of equity of Sanchez, denoted as KE. All right, because in the question we are given growth rate of 5%, we are given growth rate of 5%. So what that means is that we are going to introduce growth in our calculator, sorry, in our calculation. So I will then come here, KE equal to current dividend multiplied by 1 plus the growth rate divided by XDiv share price plus the growth rate. All of this multiplied by 100 over 1. So this is the formula for calculating cost of equity where there is growth. Okay, so I would then say cost of equity equal to, let's go back to the question and identify the current dividend. So according to the question, we are told that current dividend is 20 kobo. So that would be 0.2. 0.20 multiplied by, we need growth rates. According to the question, we are given a growth rate of 5%. So 1 plus 5% will give us 1.05. Okay, then over XDiv share price. So let's go and check from the question whether dividend has been paid or not. According to the question, we are told that the company's current dividend of 20 kobo is about to be paid. You know, when you look at the first question we solved, examiner told us that that ₦1.25 kobo is cum div. But in this one, examiner did not mention cum div. But we are told that the current dividend of 20 kobo is about to be paid, which means that this share price of ₦1.25 kobo includes dividend of 20 kobo. So you need to remove the dividend because this ₦1.25 kobo is cum div, and you don't use cum div to calculate cost of equity. It has to be XDiv share price. Therefore, let's go and make adjustment for let's go and calculate the ex-div. So let's use this space. So I will then say ex-div share price. To get the ex-div share price, so it will be cum-div share price of 1 naira 25 kobo minus the current dividend of 20 kobo. 0.20. So you less. The difference is 1 naira 5 kobo. That's our ex-div share price. You see the way we are making adjustments? We cannot go further because we need to make some adjustments. And that's why we abandon the cost of equity. Let's go and do working first. So once you are done with your working, then you come back to complete your calculation. So I can then come here to say 1.05. Okay. Then plus the growth rate plus G. According to the question, we are given a growth rate of 5%, so that's 0.05. All the whatever we get, we multiply with 100%. Okay, so multiply by 100%. So let's see. So KE will be equal to, a wise student should have gone ahead. Just use your calculator and give me the final answer. Oh yeah, let's solve this together. Use your calculator. Bring out your calculator. Let's start from the numerator. 0.2 multiplied by 1.05 equal, divided by 1.05 equal, plus 0.05 equal, multiplied by 100%. What do you get? Somebody was
25%.
talking. Pardon?
25%.
25%. Okay, Balikis has also given us 25% from the charts. All right, so that means it's correct. 25%. Therefore, cost of equity of Sanchez PLC is 25%. The cost of equity of Sanchez PLC is 25%. So that's that. Okay. So you can then mute yourself. All right. So let's have one more example before we close the class for today. Yes. Let me know. If you don't get 25% at your hand, let me know. Please always raise your hand so that you get clarity before you leave the class. Okay. Let's have one more. The next one, let's solve this example number 3. OZ PLC. Who is helping us to read this? Yes, who is helping us? Yes, Joshua, go ahead. Joshua, go ahead. Josh, I can't hear you. You raised hands. I've allowed you to talk.
Ozil PLC is a company with 5 million ordinary shares of 1 naira each, currently quoted at 1 naira 40 kobo as at 31st December 2024. The company's current dividend of 30 kobo is about to be paid. The historical trend of the company's dividend giving follows their year and dividend for 2020, 2007, 15 kobo.
You know, Joshua, get closer. Hello, Joshua, get closer to your speaker. Then you start from the historical trend.
Okay, can you hear me clearly now, sir?
Yeah, it's better now.
All right. The historical trend of the company's dividend is given below. Year dividend 2007, 15 kobo. 2008, 18 kobo, 2009, 20 kobo, 2010, 24 kobo, 2011, 27 kobo, 2012, 30 kobo. You are required to calculate the company's cost of equity capital.
All right. Thank you, Josh. Yes, that is the question. From the requirements, you can see examiner wants you to calculate cost of equity. It's the same principle. Okay, I want to calculate cost of equity. Which method am I using? You can see information on dividend as well as a share price. That means we are supposed to use the dividend valuation model. So let's look for space. We are going to do more workings under this one. I'm looking for a bigger space. Okay. Well, since you have the question with you, let me see. And I don't want to clean up this. Let me see if I can just manage this small space. Okay. The name of the company is OZ. Let's use this one. OZ PLC. So calculating cost of equity. COE is cost of equity. I shorten it. Now, pay attention, please. Pay attention to what I'm about to say. When you look at this question number 3 for OZ PLC, we are given current share price. We are given share price of 1 naira 40 kobo. And we are told that the company's current dividend of 30 kobo is about to be paid, which means that 1 naira 40 kobo included dividend of 30 kobo. So that means we need to deduct 30 kobo from 1 naira 40 kobo to have our ex-div share price. Also, in this question, you are told that the historical trend of the company's dividend is given below. So you are given the history of dividend payments. You can see that from 2007 to 2012, dividend has increased from 15 kobo to 30 kobo. That means there is growth. Pay attention, please. You will see from this question that examiner did not tell you there is growth in dividend payments, but information given to you has implied that there is growth in dividend because between 2007 and 2012, dividend has increased from 15 kobo to 30 kobo. That means there is growth. So if there is growth, then you need to go and calculate the growth rate. You need to go and calculate the growth rate. Therefore, how do you then calculate the growth rate? Are you using averaging method or you are using Gordon growth model? Certainly, because you are given historical pattern of dividend payment, that means you are supposed to, you are given the history of dividend payment. That means you are supposed to use averaging method. All right. So that's what we want to do in this question. So quickly, just let's write the formula. There is growth. Therefore, we introduce growth in our formula. DO multiplied by 1 plus the growth rate divided by XDIV share price plus the growth of this multiplied by 100 over 1. Okay, so I would then come here to say KE equal to the current dividend is 30 kobo. So here will be 0.30. All right. Multiplied by 1 plus growth rate. So let's go and calculate growth rates. Let's use this one for our workings. First thing first, we want to calculate growth rates. So G, we have identified from the question that we are going to use historical pattern of dividend payment to calculate our growth rate. Why? Because we are given the history of dividend payment. We are given the amount of dividend paid over the years from 2007 to 2012. The information about the dividend paid were given to us. Therefore, we are supposed to use the historical pattern of dividend payment. So in this case, to calculate my growth using historical pattern, And I also gave you two different formulas. I said that when you are given information about dividend payment across all relevant years, you are going to use the first formula. But if information about dividend paid in the first year and the current year are given, you use the second one. So because we are given information of dividend paid for all relevant years, so our formula will then be n minus 1 into square root latest dividend over dividend paid in the first year, all minus 1. Okay? Therefore, our growth rate will then be equal to between 2007 and 2012. How many years? Talk to me.
6 years.
6 years. Okay? So here will be equal to 6 minus 1 into square root latest dividend. Okay, the current year is 2012. Therefore, dividend in 2012 is 30 kobo. So here will be 30 over dividend paid in the first year. BD is dividend paid in the first year. So in the first year, a dividend of 15 kobo was paid. So here is 15 minus 1. Therefore, our G is equal to 6 minus 1 is 5. So here will be 5 into square root 30 divided by 15 will give us 2. Let me rewrite this. Five square root 2 or minus 1. Okay, let me continue from this other side. Now, mathematically, I can then say G is equal to 2 raised to power 1 over 5 or minus 1, because if you don't use the other formula, if you don't use this formula, I can also say G equal to LD divided by BD all raised to power 1 over n or minus 1 multiplied by 100%. We are still saying the same thing, all right? The only thing is that if you are using this formula, you must have deducted 1 from n before you can use this other formula, all right? And that's the way we are doing it now. So from your calculator, 1 over 5 is equal to, everybody please pay attention, particularly those that are struggling with the use of the calculator. Now, to get the final answer here, this is what you are going to do. 1 divided by 5, you know 1 divided by 5 is 0.2, right? So you then say 2 raised to power 0.2 equal minus 1 equal multiply by 100% equal. So here on my calculator, I got 14.87%. So G is equal to 14.87%. Approximately G equal to 15%. So the growth rate is approximately 15%. Now, the next working I need to do, or before I go for workings, I've covered the space I want to use for my calculation. So 1 plus G, growth rate is 15. So 1 plus 15% will give us 1.15. So you close this divided by XDIV share price. So we need to go and determine XDIV share price. According to the question, we are told that the share price is 1 naira 40 kobo and the current dividend is 30 kobo. So because dividend has not been paid, we need to calculate XDIV share price. Okay, let me use this side. XDIV share price. So I can say XDIV share price equal to CumDiv share price minus current dividend. Okay, therefore, XDIV share price will then be equal to the CumDiv share price is 1 naira 40 kobo. That's the share price that includes dividend minus the current dividend of 30 kobo. Therefore, XDIV share price is 1 naira 10 kobo. That's it. You can see it's not difficult, but you must understand the principle. All right. So XDIV share price is 1 naira 10 kobo. So I can then come here 1.10 plus the growth rates. We have calculated growth rate to be 15%. So plus 0.15. Everything multiplied by 100%. Let me clean this formula I wrote here. What's wrong with you? Don't waste my time. Okay. Now, I will then say KE equal to, from your calculator, what do you get? What's the final answer?
46%.
46%. Thank you. I like that. Please, if you don't get 46%, raise your hand so that I can explain. So what we did is to take 30 multiplied by 1.15 equal, divided by 1.1 equal, plus 0.15 equal, multiplied by 100%. That will give you 46%. Therefore, the cost of equity of OZ PLC is approximately 46%. So that's that. Let me know if you have any question for me under the last question we just solved. Otherwise, I'll just do a recap on what we have done today, and then that will be the end of today's lecture. Any question on this? Any question? Is anything do you why? Or is there anything you don't understand so that I can explain? All right. So, yes, Kemi, talk to me.
Thank you, sir.
Yeah? Yeah.
So my question is sounds silly. Just put me through, sir. When we say come give, like a subscriber now want to subscribe to a company share, the price that will be quoted, will dividend be included in the share price, or is that how they do it in a real sense? Because I just want to know why are we having div in a quoted price?
Now, what we are saying is that when you talk about cum div, like I explained earlier, it means that the dividend has not been paid. And if you want to determine cost of equity, when you want to estimate cost of equity, you are supposed to use the share price that exclude dividend. You cannot be owing me dividend, and you want to determine just to be sure that the cost of capital is realistic and appropriate. And that is why you must remove dividend from the share price. Remember, the share price is the market price of the company's share. All right, that's the market value, that's the market price of the company's share. So it is expected that before you determine that market price, you would have paid the dividend. So if you have not paid the dividend, then and you want to determine the cost of the capital that you have used, then in that case, it is expected that you are going to deduct the dividend from the share price before you go ahead to calculate the cost of equity. So the concept is saying is that if there is indication in the question that dividend has not been paid, then you cannot use the share price as given to you because the share price given is the cum. Cum means it includes dividend. That is cumulative share price. It includes dividend. So you have to remove that element of dividend. So what you have thereafter is the share price that you should use for calculating the cost of equity. Now, the bottom line is that in practice, remember earlier today when I was telling you when we were discussing the usefulness or significance of cost of capital, we said the first one, one of the importance of cost of capital is for project evaluation, investment appraisal. When a company in practice, when a company wants a project, it is expected that you are going to evaluate, you are going to appraise the project to be sure that the project is financially viable, that you can commit your financial resources into executing the project. So for you to be able to undertake or to evaluate the project, you are going to need the essence of cost of capital is for you to be able to appraise a project. So without the cost of capital, you will not be able to do it. So when you now want to calculate, in practice, if a company wants to execute a project, undertake a project, and you want to evaluate it, so to calculate your cost of capital, all these things we are doing are what you are going to do, even in practice. Do you get, Kemi?
Yes, sir. Yes, sir. Thank you, sir.
So for you to be able to evaluate that project, you must calculate your cost of capital. So in doing so, for you to be, when calculating the cost of capital, all these procedures we are doing, all these processes are what you are going to go through, even in practice, even though you could have developed your model for as a company for you to be able, so that going forward, when you have a similar project, it will be faster if you have a model in place in practice. All right. But again, so that's it. Okay.
Thanks, sir.
You're welcome. Any other question? All right. Let me just as a recap so that we know where we are going to continue in our next class by the grace of God. So today we started with introduction to cost of capital. After that, we talked about the importance of cost of capital. After that, we moved to discussing categories of cost of capital. And I gave you the procedures involved in calculating methods of calculating cost of capital, which include traditional weighted average cost of capital, project-specific cost of capital, and then WACC, that is weighted average cost of capital of the combined activities. And we started with traditional weighted average cost of capital. And I said that traditional weighted average cost of capital is computed when information about capital structure, that is ordinary share capital, preference share capital, and debt capital are given, including the dividend and then interest. When you have it in a question, that means you are supposed to calculate traditional WACC. Now, when I said that there are 4 procedures in calculating traditional WACC, there are 4 procedures you are supposed to follow. The first step is to calculate cost of equity. Second step is to calculate cost of preference share. The third step is to compute cost of debt, and the last step is to estimate weighted average cost of capital. We now started with the step 1, which is estimating our cost of equity. We talk about the meaning of cost of equity, which is the minimum required rate of return expected by the ordinary shareholder from their investment in a firm. Then thereafter, we talk about the method of calculating cost of equity. We talk about dividend valuation model, capital asset pricing model, and then Miller and Modigliani. So we now started with dividend valuation model. I gave you the meaning of dividend valuation model and how to calculate cost of equity using the dividend valuation model. After that, we talk about the concept of, I gave you two different formulas of cost of equity using dividend valuation model. Then thereafter, we talk about the concept of cum div and ex div share price. Then we move to discussing how to estimate growth rates. And then that's where we stop in the concept, in the analysis or the explanation of the concept before we now had about three different short examples just to drive home the points that we have discussed. So that is what we have done today. By the grace of God, when we are going to be meeting next week, Monday, we are going to have two additional worked examples relating to cost of equity. After that, we are going to move to cost of preference shares. So if we still have time on that day, then we'll move to cost of debt. Okay, so that's what we are going to do next week, Monday, by the grace of God. Since I don't know if you now have another question for me so that I can attend to you. If not, we close the class for today. Some of you have left. Talk to me if you have any question for me so that we can close the class. Okay. So, in the absence of no further question, I want to say thank you to every one of you for joining the class. We are going to meet again by the grace of God next week, Monday. However, on Wednesday, Mr. Shuaju will be having you. Of course, I'm going to share these notes. You can only see these notes in the video recording. Since I'm not using working notes, so this one will not be used. It's not shareable. All right, but I will ensure that you get the video as quickly as possible. All right. Okay. So thank you, everyone. I will see you next time by the grace of God. Bye-bye.